Hello, my name is Amit Trivedi. Well, let's understand various financial products and services, the taxes applicable on those. And when we look at taxes, we'll take a look at income tax as well. And why is the tax collected? Tax is a major source of revenue for the government. And from that point of view, we'll also take a look at the finances of Government of India. So, in this chapter, we'll cover these points. As we just said, number one, the various financial products, the tax applicable on those, the finances of Government of India, and the basics of income tax returns. The entire spectrum of financial services can be broken down into various categories. There are different ways of breaking these down. Here is one approach where we'll look at insurance, we'll look at various types of deposits, but largely used for a relatively long-term parking rather than the so-called demand deposits, which is nothing but savings account and current account. So, in the banking language, savings account is also called a demand deposit. However, we will be looking at something known as time deposit, where the deposits are made for a certain period, the typical fixed deposits that all of us are familiar with. Something similar to fixed deposits, but with a few differences. Similar in the way that both invest at a similar place in a similar manner, but the investor experience may be largely dependent on the structure of the vehicle. So, from deposits we look at liquid or debt mutual funds. Various ways you can access stock markets to invest long-term money to benefit from the growth of the economy. What are these ways? We'll primarily look at three. From that, let's now go on to something which is more day-to-day in nature, which is where the payment solutions or payment products would come in. They may be in physical form, they may be in electronic form. When we need money for large purchases and in a situation when we do not have our own funds available for some reason, we may resort to taking loans. Apart from borrowing, the interest rate, the purpose, the terms, the interest rates, the payment schedule, we'll look at some of those features when we discuss loans. One of the major goals in life, one of the important events or stage of life is retirement, and for that purpose, the retired person, when one needs a pension, what are the various schemes available? We'll look at pension schemes largely from the point of view of accumulating a corpus to fund the retirement requirements. While we looked at certain investment products at the top, the debt and liquid mutual funds, fixed deposits or stock market related instruments, the one important investment instrument is bonds, also often referred as debentures. We look at these products. Let's look at some of the features of these products, the kind of products that we have, and the purpose for which these products can be used. In the personal finance space, there are these 6 major categories of insurance products that we would need. But primarily, the purpose of insurance must be understood. The way the instrument works must be understood. The purpose is to minimize the financial loss on account of unexpected events. Now, this purpose also tells a lot of things. First of all, the event is unexpected. Now, unexpected means it may happen or it may not happen. This is one way of looking at the unexpected part of the event. And this is where, when you look at a motor insurance, it's actually about an accident or a damage happening to the vehicle. So, an accident or a damage may or may not happen. This is one part of the uncertainty. The second part of the uncertainty is unexpected nature, is that you don't know when it would happen. And this is largely applicable in case of life insurance policies, because while death is not an uncertainty, the time of death is uncertain. Death may come early or it may come late. And from that point of view, look at the word unexpected. Second, there has to be a financial loss which needs to be minimized or reimbursed. Now, let's quickly look at each of the insurance policies that we have listed out here and then keep revisiting this definition or the purpose. Life insurance. It's a kind of policy where the insurance is taken on the life of a person. In the event of death of that person during the term of the policy, whatever is the risk cover, the insurance company pays to the nominee of the insured. However, during the term of the policy, there may be a requirement of paying regular premium to keep the policy live. Okay, there are some variations where there could be a one-time lump sum insurance premium and the policy has a defined term. But whatever the case, there is a defined term within which, if the death happens, then the nominee gets the claim. But what happens when the term gets over? And that's where there are different types of policies. In one particular category of life insurance policies, which is called endowment kind of policy, whatever premium is paid during the term, some part goes towards risk cover and some part gets invested, and at the end of the term, whatever is the amount mentioned in the contract, the insurance policy contract, that amount, the maturity amount, is payable to the policy holder in the event of the policy holder being still alive at the end of the policy term. This is one type of policy. Another type of policy is known as unit linked insurance plans, ULIP in short. In this category, some part is invested and some part goes towards the risk cover. But unlike in case of endowment plans where the maturity amount is stated, in case of ULIP, the returns are market driven depending on what that investment portfolio generates the maturity amount may vary. The third type of policy is called a money back policy, which is a variation of the endowment plan, in the sense that while there is a maturity amount, but periodically at the defined timelines, some amount is paid back to the policy holder. The final type of life insurance policy is called the pure term life insurance. In case of pure term life insurance, the policyholder continues to pay premium like any other policy during the life of the policy. However, at the end of the term, if the person is alive, the policyholder is alive, then the insurance company has to pay nothing. There is no maturity amount. And because of this reason, because the insurance company does not have to pay anything on maturity, the premium payable in case of term life insurance is the least compared to all the other policies. Now, let's look at the purpose that is mentioned out here. When there is a death in the family faces two kinds of losses, or family may face two kinds of losses. One is the emotional loss that a close family member has passed away. The second could be financial loss if the person who passed away was an earning member of the family. When an earning member passes away, obviously the future income that one would have earned stops. It is this financial loss that must be compensated through life insurance policy, and that's why it's the financial loss that is to be compensated or reimbursed or minimized. However, when you look at reimbursed or compensated, that applies largely in case of a policy like health insurance or a motor or a fire or theft insurance. When a person falls sick and is hospitalized, one has to incur certain expenses. If one has taken a health insurance policy, these expenses may be reimbursed by the insurance company. So, two types of policies. In one case, there is a reimbursement. In another type of policy, in the insurance language, it's called benefit policy, where how much money would be payable at the time of the claim is predefined. In case of reimbursement, only the limit is predefined, but the actual amount of reimbursement would vary depending on how much expenses are incurred or how much is the loss one has taken. And this is where it's a huge benefit or advantage, so that when the downside is covered through insurance, one can now little more comfortably build an investment portfolio to enhance one's life. The purpose of insurance can also be seen as a protection against events with negative outcome, when you have that downside protection, a portfolio could be built that can enhance the financial well-being or the wealth of the individual or the family. Now, that's as far as insurance is concerned. We said first is life insurance, second is health insurance. Health insurance also can be divided into different types. But one of the policies related to health is also called critical illness insurance, that covers the expenses that one may incur during hospitalization or treatment, which is on account of certain critical illness. What could this critical illnesses be? It could be related to a failure of kidney, it could be a cardiac arrest, it could be a brain stroke. So, some such critical illnesses get covered through that policy separately. Medical insurance can apply to a wider range of illnesses where medical insurance is largely a reimbursement policy. The critical illness policy is largely a benefit policy, which means the agreed or contracted amount is paid at the time of onset of that critical illness. So, critical illness in a way also gives sort of compensation for the potential loss of income. Fire, motor, theft and accident insurance are relatively easy to understand. However, the accident insurance is often clubbed with accident and disability insurance, and this disability could be partial, it could be full, it could be temporary or it could be permanent, and this disability typically covers the eyes, limbs, etc., because of the loss of which one may render jobless. Consider this insurance as a shield that you get, and with this shield the life can become a little smoother. When it comes to the deposits, the deposit could be created in two ways. One is a fixed deposit that typically requires one single investment over a certain period, and this period is also called maturity period. Deposits in banks could be created for as short a period as 7 days or 15 days and as long a period as 7 years. If you look at companies which collect fixed deposits, the deposits could be made for, generally companies take deposits for 1 year to 5 years. There are certain companies like housing finance companies which collect deposits for a period as long as 10 years also. The other type of deposit is called recurring deposit, wherein you keep investing money on a recurring basis at a set frequency, typically monthly frequency. These kind of deposits can be opened in banks or post offices. Fixed deposits could be opened with banks, post offices or companies. What do they do? These deposits have a certain defined time period and a defined interest rate. The interest frequency could be picked up, and in case of fixed deposits in particular, one can go for monthly interest, quarterly interest, annual interest or cumulative, which means the entire interest only accumulates and paid along with the principal at the time of maturity. Recurring deposits typically don't pay interest because the whole purpose is to accumulate corpus through regular investment. So, when you are regularly investing on one side, it does not make sense to take interest out, and there is some maturity amount at the end of the period. The deposits which the companies issue, within that the non-banking finance companies or the real estate companies, the deposits that the companies issue, especially the non-banking finance companies and housing finance companies, you will have credit ratings assigned to these companies. In other cases, credit rating may not be mandatory. Look at this credit rating because that tells you about the opinion of the rating agency about the ability to pay the principal and the interest as per the defined time period. Different deposits will have different interest rates. lot of times people go for higher interest rates without realizing that the banks or the companies which are perceived to be safer, they tend to offer lower interest rates, and those who offer higher rates might be perceived as less safe. So please understand this distinction as well. The deposits are typically used by people to meet their large near-term expenses. However, the recurring deposits or even some of the fixed deposits could be made for medium-term and long-term goals as well. While fixed deposits have a fixed interest rate, they also have a fixed term. And when they have a fixed term, what do you do if you need money before the maturity of the deposit, or what do you do if your requirement of funds gets delayed beyond the maturity period? Take a real case for example, that one particular person had some money on hand right now, and this money was required after 3 years. In such a case, if the money is required exactly after 3 years, one can simply go to the nearby bank and put money in a 3-year bank deposit. Or one can go to a private company and put money in a 3-year deposit with that company. Now the question is, for some reason, the event for which money was required gets rescheduled for an earlier date. So let's say 2 years or 2.5 years. And in such a case, the person would be required to break that deposit on a premature basis. However, if the event gets delayed for some reason, then one will have to look for another instrument for that remainder period. Once again, if that remainder period is certain, one can open another fixed deposit for that term. But if that period is also uncertain, what do you do? To deal with such certainty or uncertainty in term, there is another way of approaching the investment in the so-called safe asset category, debt funds. These debt funds or liquid funds come from mutual funds. They invest in debentures and bonds issued by governments or private companies. And depending on the investor's requirement, the investor may choose different types of liquid or debt funds. Now, in these funds, the big difference between them and the fixed deposits or the bonds that we'll cover later is that neither the term is fixed nor is the return fixed in case of debt and liquid mutual funds. But they add a layer of flexibility. Now, this is where these funds can be utilized. Once again, the purpose of these debt funds or liquid funds is going to be for short-term and medium-term requirements. For the long-term investment requirements, experts recommend that you must look at stocks or the stock markets or various instruments available or investment vehicles available through which you can invest in stocks. And primarily, one may consider from these three. Number one, you may directly buy stocks. Number two, you may invest through equity mutual funds. Or number three, you may invest through exchange traded funds. The ETFs or exchange traded funds are also mutual funds where the units of the funds trade in the stock market the way a typical stock would be traded. While these instruments are perceived to be risky, they also have the potential to generate superior returns over a long period of time. Once again, a majority of experts would suggest that don't invest money in stocks or stock market related instruments if your investment horizon is short term or medium term. But if your investment horizon is long term, don't ignore this category. This particular category also has the potential to create wealth over long term. What do we mean by that? The returns that you get out of these instruments or these vehicles generally beat inflation even after adjustment for taxes or even after payment of taxes. And to that extent, what you could purchase today, at a later date, you would be able to purchase much more. Your purchasing capacity or purchasing power goes up, your wealth has increased. This is a little more familiar territory, and this familiar territory is nothing but the payment products, because on a regular day-to-day basis for various things we keep making payments, and for that some of the most common instruments that we use are a bank account with a checkbook facility. We use checks, demand drafts, bankers' checks, etc., etc. Electronically, we can use National Electronic Fund Transfer Facility (NEFT) or the mobile payment service IMPS or the real-time settlement system RTGS. These are electronic methods of making payments. We also have the cards, the credit cards, debit cards for making various payments. And finally, the payment wallets, which is the recent innovation. And with the arrival of Unified Payment Interface, which is an initiative of the NPCI, the wallets have become quite seamless, smooth and much safer, because now an electronic wallet need not be funded. There are payment systems, payment apps, either through banks or various other companies, and these apps ride on UPI, the Unified Payment Interface, and transfer your money from your account to the person to whom you want to make a payment. And it's a revolution to such an extent that today the world is taking note of this innovation that India is successfully launched. Today, there are millions of transactions happening every single day, seamlessly, free of cost, and small amounts to large amounts. Today, you can make a payment for a cup of tea, or you can make a payment for a dozen bananas. You can make a payment through UPI or through these apps for large ticket purchases as well. What do these mean? What do these do? These are nothing but payment instruments. While UPI has become quite famous, the wallets are quite popular these days, many have stopped using the checks and demand drafts now. A check is written by the account holder with a checking account, signed by the account holder, and it goes for clearing. So when Ram makes payment to Shyam through a check. Shyam would go and deposit this check in his bank account, and from his bank account, it would go via RBI's clearing mechanism to Ram's bank account. And when the credentials of the check are verified, the account details and the signature of Ram, everything is verified, and if everything is found in order, then money would be taken out of Ram's account and transferred to Shyam's account through Reserve Bank's clearing mechanism. On the other hand, if Ram and Shyam don't know each other, Shyam may insist that I want a demand draft or a bank manager's check, in which case Ram will have to purchase that demand draft or the banker's check, and by purchasing he'll have to actually transfer money from his account to the bank's account, and the bank manager would now issue an instrument. Demand draft is also popularly called DD, the short form it, or it is also called banker's check. And then this instrument is a prepaid instrument because Ram has already made the payment. Then when it goes to Shyam's account, Shyam's bank does not have to worry about checking Ram's credentials. The bank only will check the credential of the other bank, and to that extent, Shyam is guaranteed to get the payment because the bank is solvent. In case of a check issued by Ram to Shyam, there is a possibility that while Ram might have issued a check, and after that not enough money would be there in the bank balance. In such a case, the instrument would go back. These days anyway, the usage of these instruments is on a steep decline, largely because the electronic instruments are being used far more. So checks and demand drafts are physical instruments, NEFT, IMPS, RTGS and the wallets are digital. What are the cards? Cards are the plastics. You carry those small plastic cards. It could be a debit card or it could be a credit card. Use that for various purposes, including making payments. The magnetic strip and the telephone line at the merchant's end, they verify certain details. The credentials are captured in the card. There could be an OTP, there could be a PIN, there could be a CVV, various safety mechanisms, and the payment gets seamlessly processed. But once again, after the arrival of UPI, the usage of cards for the purpose of transactions is also on the decline. This is an overall scenario of what's happening on the payment side. Next in line is the loans. And loans are somebody else's money borrowed for a while with a promise to repay. When you repay, it's not just the principal that is to be repaid, there could be an interest payable on that as well. The payment frequency could be different, and that is the part of structure of the loan. In the personal finance space, the most popular of the loans or most common of the loans are home loan, education loan, vehicle loan, personal loan. Now, all these loans could be different in terms of the size of the loan, different in terms of the term for which the money is borrowed. The interest rates on these loans could be very different, and the payment frequency also could be different. However, the home loan and vehicle loan in particular have a sort of similar structure where you take that loan upfront and repay in form of what we popularly know as EMI. This word EMI is reasonably common, reasonably popular word. The full form of this EMI is equated monthly installment. So the principal amount that is borrowed and the interest payable on that principal amount both go on a month-on-month basis in form of installments which are equal in size month after month. So some part of that installment would be principal repayment and some part would be interest payment. Sometimes it is also referred as reducing balance, because as principal gets repaid in part month after month, the loan outstanding keeps going down, the loan balance keeps reducing over a period of time. Education loan typically, because it is for the purpose of funding education, which is generally a graduation or a post-graduation program, which is 3 years, 4 years, 5 years, whatever may be the case, depending on what kind of education one is pursuing. In most education loans, the repayment starts after the education is over, and often there is even some moratorium period after the education is over. So let's understand that first. If Suresh takes a loan for his daughter's graduation, assuming that the graduation program is a 4-year program, the education loan is taken right now, or every year the fees would be paid out of the through the loan. The repayment of that loan would commence after Suresh's daughter completes her graduation program. If there is a moratorium period of 1 year, then the repayment of the loan would start 1 year after the graduation was completed. But it does not mean that the loan does not attract interest for that period of moratorium. The interest is added to the outstanding loan amount, and to that extent, while the loan could be X, when the repayment starts, the loan would be whatever money was taken out plus the accumulated interest on that loan, and that much would have to be repaid over a period of time. So education loans are typically with moratorium period. Personal loan, on the other hand, are a different thing altogether. They are taken generally for shorter periods, generally for some expenses to be incurred, generally for purposes to bridge a gap. Let's take some examples. Somebody is expecting a large amount to be received, let's say in December. However, while the receipt is likely to happen in December, there is a large expense to be incurred in August of the same year. And in such a case, this person may avail of a personal loan in August, utilize that money for that particular event, and when the large lump sum is received in December, that loan gets repaid. There could also be a reason for which the loan may be required. Let's take a health insurance policy, which is not a cashless policy. It is a reimbursement based policy. When the patient's relatives first paid the hospital, then put a claim, and the insurance company then later reimburses the money. Again, in such a case, if there is no money on hand, a personal loan may be availed to pay the hospital bill. And when the claim is settled by the insurance company, the loan may get repaid. There could be multiple such purposes. The other way to look at these loans is the home loan and the vehicle loan both would be secured loans. And what is secured loan? A secured loan is when the bank takes some sort of a security. Now call it hypothecation in case of a vehicle, call it mortgage in case of a home loan, but there is a security of an asset. In case the borrower is unable to repay the money, the bank has the right to take over that asset, whether it is a property or a vehicle, and make the loss good. Personal loan is always unsecured. There is no security to be given to the bank in case of a personal loan. Now, between a secured loan and an unsecured loan, the interest rates on unsecured loans tend to be higher than the secured loans. But what about education loans? Would they be secured or unsecured? In many cases, up to a certain amount, the bank is okay giving an unsecured loan. But if the amount exceeds, then the bank may ask the parent of the student to give some form of security. And based on what the bank's norms are, bank's comforts are, the security may be decided. But these are some nuances that one needs to understand. Each loan is a contract between the bank, the lending institution, and the borrower. The terms of the contract must be properly read and understood, at least for the sake of taking the right type of loan. Do not forget this last line. The loan has to be repaid along with interest, and interest is an additional expense. So to that extent, whenever one is considering to take a loan, take a judicious and informed decision. Retirement is an important stage of life. It is that stage when the income stops, expenses don't. Earlier, people used to work till a period that was defined by their respective employer. The retirement age was defined. Till 2004, whoever joined government services, in case of those employees, and the private sector, in case of those employees, the pension was also guaranteed for life by the employer. But these days, there is no guaranteed pension, and you got to invest money in various pension products to accumulate a sum, and that sum can be used to withdraw or to generate income to fund expenses in retirement. So, as was mentioned in one of the sessions, the society has moved from the so-called defined benefit system to defined contribution system. And from that point of view, the responsibility is on the individual to create sufficient retirement corpus. How do you create retirement corpus? The most popular investment avenue for that is the employee provident fund available to salaried employees of companies. Of course, very small companies don't need to have this EPF, but companies beyond a certain number of employees must participate in EPF scheme. The companies which have not opted for EPF have to opt for what is called National Pension Scheme. Those who are not employed anywhere, so people who are self-employed or otherwise freelancers, etc., or people in the gig economy, they can participate in Public Provident Fund, and these accounts can be opened with post offices or certain banks. The same individuals can also build a retirement corpus through National Pension Scheme. So NPS is available to employees, salaried employees, as well as all the others, self-employed, professionals, gig economy workers, freelancers, everybody. These products are designed to accumulate savings. So you keep investing, and because the primary purpose is to accumulate savings for retirement, these products have a certain period of lock-in, which means during that period the investor cannot withdraw money. In something like an EPF or a PPF, there is no interest payable, though they are equivalent of a debt investment. Whatever is the interest, that gets reinvested in the same EPF or PPF account. Considering that our longevity has increased, which means we are going to spend more years in retirement, it's important to do the calculation of how much retirement corpus may be required and then plan backwards and start accumulating money for that retirement fund early in life. The earlier one starts, the better it is for one. The larger corpus one can create. Delay could often turn out to be pretty costly. One of the investment products that we can consider is called bonds. There is another name for that, debentures. Who issue these papers? There could be governments, there could be municipal corporations, there could be public sector undertakings, private companies. Various entities can issue these bonds or debentures. Like in case of fixed deposits, debentures also have a fixed term. Debentures also pay interest, and this interest again could be monthly, quarterly, half yearly, annual or cumulative, but in most bonds the most common payment frequencies are half yearly, annual or cumulative. And these are the popular frequencies, not necessarily the default frequencies. Debentures and bonds, whenever they are offered to public, except for those issued by the governments, all the private sector bonds or debentures must have a credit rating. Higher credit rating is an indicator of safety. Lower credit rating means the safety is also lower. And these credit ratings are mandatory if these debentures are offered to public. There are two other names mentioned out here, and let's look at each one. The fourth one, tax-free bonds. Very often, in order to raise revenue, the governments may allow some of the public sector units, and public sector units are those which are owned by Government of India or state governments. So the governments may allow some of these public sector undertakings to issue bonds and pass certain rules through which the interest on these bonds is tax exempt or tax free. As an investor in those bonds, if I earn some interest, I don't have to pay any tax on that interest income, which increases the attractiveness of these bonds. Largely, public sector undertakings are allowed this, but then again, of late, the frequency of such issuances is also on a lower side. But where the issuance frequency has gone up is a category called sovereign gold bonds. So first of all, these are bonds. Though the name contains gold, this is not a gold investment, this is investment in a bond. The issuer is sovereign. Sovereign means the Government of India is issuer. So it is a Government of India bond. So what does the word gold do in between? The purchase price and the maturity value are linked to gold price in the market. So if I buy or rather invest in a sovereign gold bond right now, and let's assume that the price of gold is 100 rupees, just for example. 8 years later, when this bond matures, if the price of gold is 125 rupees, my maturity value would be 125 rupees. If the price of gold is 500 rupees, I'll get 500 on maturity. And along the way, every half year, the bond pays interest to the bond holder. This interest is 2.5% per year. 2.5% per year means 1.25% every 6 months. So if I invested 100 rupees, every 6 months I'll get 1 rupee 25 paisa. And this interest is tax free. So that makes this particular bond quite an attractive one. One, the price is linked to gold. People expect appreciation over that kind of a period. The interest is payable and that interest is tax exempt. There are different types of bonds, but because the maturity is fixed along with the interest, generally because these bonds are medium to long term bonds, they may be used for meeting medium to long term financial goals. Now, while there are these very interesting investment avenues, there are many more avenues that we have not covered in this list. But what we'll now do is to look at the tax treatment on these products. So what is the tax applicable? Are there any other provisions that one needs to keep in mind? We'll look at those things. Let's start with the individual products and look at 3 particular points. Number 1, when you purchase, what is the tax treatment, if at all? What is the tax treatment at the time of maturity? And what is the tax treatment when you receive any income in whatever form? When you open a savings account with a bank, or when you deposit money in the savings account, there is no incidence of tax. There is no tax applicable on the money that you deposited. There is no tax benefit that you get for depositing the money in the savings account. Similarly, when you withdraw money from that account, whenever you do, again there is no tax, there is no tax benefit. But when you earn interest on the balance in savings account, beyond a certain limit, currently that limit is 10,000 rupees per year per pen holder. Up to this limit, the interest is exempt from tax. Any interest earned over and above that is subject to tax. So, savings bank account to a great extent is tax exempt vehicle. Your interest needs to be below a certain limit. The moment it crosses that, the amount that goes above that would be taxed. So, let us say if I earn in a year 11,000 rupees as interest on my savings account balance, 11,000 is more than 10,000. So, there should be an incidence of tax. However, the first 10,000 is exempt. So, only the 1,000 would be subject to tax. Then the fixed deposit or the recurring deposit account. When you open that account, there is neither any tax payable nor any tax exemption. But within fixed deposits, there is a category called tax saver fixed deposit. If you open this specific tax saver FD, then you get tax benefit under section 80C of the Income Tax Act. But let us complete the discussion on the regular FD first. There is no tax exemption available in this case. On maturity, because the amount invested and the maturity amount is the same, because of which the maturity amount is not taxed. What is taxed in both the cases, the regular FDs or tax saver FDs? In fact, even in case of recurring deposits, the interest is taxable from the first rupee. Unlike in savings account where the minimum level was 10,000, anything below that is tax exempt. In case of fixed deposits or recurring deposits, every single rupee of interest is subject to tax. The retirement product EPF or PPF, when you invest, there is a benefit under section 80C. We'll later, after covering all the products, we'll have a little discussion on section 80C because it is important. The interest that you earn on your EPF or PPF balance is exempt from tax. And the maturity amount is also exempt from tax. So, if you have an EPF account or a PPF account, you get tax benefit in the beginning, you get tax exemption on the income, and you get tax exemption at the time of maturity. From tax exemption point of view or tax benefit point of view, PPF and EPF are among the most tax efficient products. Then comes the sovereign gold bond. Investment time, no tax applicable, no tax benefit available. Interest, tax exempt. Maturity amount, if you hold till maturity, no tax. The only thing that you need to remember is, in case of sovereign gold bonds, after completion of 5 years, you are able to sell it in the secondary market. If you do that, the profit on account of sales price being higher than the purchase price, that profit is called capital gains, and that capital gains is subject to tax. Debt or liquid mutual fund, there is no tax treatment at the time of purchase, nothing. But if there is any interim income in form of dividend, that is taxable. However, you could also go for growth option, in which case the interim period is tax exempt because there is no income to the investor. And finally, when you take your money out, whether it is dividend plan or growth plan, the increase in value or the sale price minus the purchase price, that gap, that profit is called capital gains, and that capital gains is also subject to tax. equity mutual fund, barring one particular scheme called ELSS, equity linked savings schemes, all equity mutual funds do not have the tax benefit under section 80C. ELSS has that tax benefit under section 80C. Once again, at the time of investment, there is no tax on these also. If you opt for dividend in either case, be it equity funds or ELSS, that dividend is taxable. And whenever there is a capital gains, that capital gains are also taxable. However, like the liquid and debt mutual funds, you have an option of going for growth plan, in which case only the capital gains remain taxable because there is no interim income, there is no case of tax at that point in time. Among the insurance products, the life insurance, health insurance and motor insurance are only covered for this discussion on taxation, while earlier in products discussion we covered a few more. In case of life insurance products, you have section 80C benefit subject to certain conditions. The returns, essentially the maturity amount, is tax exempt subject to certain conditions. There is no interim income in this case anyway. So, there is nothing receivable in between. However, the Income Tax Act puts certain condition wherein if the investment component is significantly larger in comparison to the insurance component, it is a quasi investment product, and to that extent the maturity amount may become taxable. So, there are certain conditions applicable that way. The health insurance products, they have tax benefit under a different section called section 80D, and in this case the premium paid for health insurance for self as well as premium paid for health insurance of dependents, all these get covered. So, one can avail of tax benefit on the health insurance paid, premium paid for the dependent children, dependent spouse, dependent parents. The income does not happen, so there is no question of tax on any income. The amount that you receive at the time of claim is not taxable. It is a reimbursement of expenses. So, again insurance proceeds are tax exempt. In case of motor insurance, you do not get any tax benefit. Life insurance, there is a potential 80C benefit, health insurance 80D benefit, motor insurance no tax benefit. In case of motor insurance, there is no interim income, no case of any exemption or any taxation. And finally, the claims received under motor vehicle insurance, the claims are also tax exempt. Now, in case of loans, we have cut down on one thing, which is the income, interim income. Here you have repayment and the interest payment. So, principal repayment and the interest payment. When you take a home loan, principal repayment is eligible for exemption under section 80C. Interest paid is eligible for exemption under section 24B. While the limit for section 24B is 2 lakhs per year, section 80C, which we have talked earlier also, there is a combined limit of 1,50,000 per year. If you have opted for the old tax regime, this section 80C benefit is not available under section under the new tax regime. Education loan is also eligible for benefit under section 80C. The principal repayment has no tax exemption. Education loan, the principal repayment is eligible under section 80C for tax deduction. The interest payment is not exempt under any of the income tax clauses. Personal loan, there is no such thing as any tax exemption. The first two, home loan and education loan, are primarily taken to fulfill some major financial goal in life, and to that extent the exemptions encourage a responsible behavior. Personal loans are most cases for luxury purchases or sometimes very short term situation, which is a negative kind of a situation. There is no tax exemption offered. So whenever we talk about taxes, a lot of times people ask this question: why do we have to pay taxes? The real reason for payment of taxes is that taxes are a major source of revenue for the governments. And what do they do with the money collected through tax? Why do they need this money? That becomes second question. And for that purpose, it's important to understand the earnings and spendings of the Government of India. The presentation of these earnings and spendings or government's inflows and outflows happens once every year. That event is known as the presentation of Union Budget by the Finance Minister in the Parliament of India. So anybody who wants to take a look at Government of India's finances, the Union Budget is the document to look at. Or one can also take a look at Economic Survey of India, which is published a day before the presentation of the budget. We have taken data from that document only. Now, when we look at our own situation, we have certain expenses to incur for which we earn some money, and that parity between income and expense must be judiciously maintained so that as a household, as a family, we do not run out of money. Any company also has to maintain that, and equally any government also must maintain a judicious balance between the income and the expenses. Government of India is not an exception to this rule as well. The Economic Survey of India 2023-24 gave this pie chart which shows the breakup of the revenue of Government of India, the inflow to the Government of India. The title to the chart is little more explanatory in the sense that it says where does the rupee come from as far as the Government of India's coffers are concerned. Look at various items. Right here is the loans that the Government of India takes, the borrowings. Then there are some non-tax receipts. There could be sometimes some penalties or fines and stuff like that. These are not related to tax. There are capital receipts that the Government of India gets, could be dividends from the public sector undertakings, etc. Customs duty is one type of tax, as we all know, and then from there on it just goes on till here, and you see only taxes. So if I just add up the numbers, 4% is customs, 17% is GST, 15% is the corporation tax, 7% is the excise duties, and 15% is the personal income tax. 15 plus 15, 30, 37, 37 and 17 is 54 plus 4. 58% of Government of India's inflows come through taxes. Out of this 58%, 1/4 of that 58% comes from personal income tax. And to that extent, the contribution of personal income tax is significant. But what for? And that's where we need to see where the rupee goes. What is the outflow of Government of India? Because the borrowing is large, the interest payment is equally large. Second, there are various schemes sponsored by the center, and these are either developmental schemes or social upliftment schemes. For example, the money spent towards building schools, hospitals, roads, the money spent for Manrega kind of schemes, the centrally sponsored schemes. Subsidies, whether it is farm subsidy, whether it is petroleum product subsidies, various subsidies where the Government of India spends money. Defense expenditure is 8% of the total outflows. Certain central schemes, now there are centrally sponsored schemes and central schemes, and both could be very different in the sense of central government's involvement. Finance Commission and other transfers, which largely goes towards pension of retired government officers or salaries and stuff like that. 18% of outflow is towards passing on the tax revenue to the state governments. And then 8% is other expenses and 4% is towards pensions. As you can see, a good amount of expenses go towards things like subsidies, defense, developmental activities, social upliftment activities. If you look at that, in order to run the government machinery, the money that is required in order to provide development to the nation, upliftment of the poor, the money that is required, predominantly that comes from taxes. And that's where it's important that all the citizens pay their taxes properly and diligently. Every year, because the financial year ends on 31st March, all the individuals are required to prepare a statement of their income and do the calculation of tax on that and pay the income tax on certain dates, file the income tax return on or before 31st of July. So, for the year ending 31st March 2024, the income tax return must be filed on or before 31st July 2024. Income tax return is a self-declaration that every income tax payer files with the government. Government then scrutinizes that self-declaration, and if there are any discrepancies found, then they may raise a claim. But overall, over the years, as the process has been simplified in a large number of cases, the tax returns go through smoothly. In many cases, because people pay advance taxes, there could be refunds payable by the government. three important forms. First is for salaried employees. The employer gives a form number 16, because when you are working in a company, out of the salary, the employer would have deducted certain tax, and this is called tax deduction at source, or TDS. The details of the employee's income and the TDS would be available in form number 16. Those who are not working in a company but earning money, in their case also there would be a TDS. This TDS would be deducted by all entities other than the employer. Let's say if I've got investment in a bank deposit, beyond a certain limit, the bank would deduct tax at source, and that would be given to me by a bank in form of form number 16A. Form number 26AS gives summary of all the taxes that one would have paid as advance taxes, any TDS that has been deducted, and various other items which get covered under the respective provisions of the law. This form number 26AS is quite a detailed form capturing a lot of financial transactions and income related details of an individual. The simple process for salaried employees in particular, you got to choose the right form. Of course, the procedure is applicable across, but the procedure tends to become a little more complex as one moves from salary income to more towards business income or other such factors. Choose the right form. Then there is an Excel utility on the income tax website. One can prepare the IT return straight away using that utility. Then the required file has to be uploaded in the format that is specified by the Central Board of Direct Taxes, or CBDT. Step number 4 is that ITR form, income tax return, must be verified. Once it is verified, IT department would issue what they call the acceptance that the IT return is filed. And finally, the IT department would process that return and they would pay refund if any refund is due in a specified period of time. Let's take each of these 6 steps in detail. What kind of form one has to fill up? If the income is only from salary or pension and one house property, then that's the simplest of the structures and the simplest of the forms, which is ITR1, income tax return form number 1. When apart from the above there are capital gains from the investments, then it is ITR form number 2. So salary or pension, one house property, ITR 1, salary or pension, one house property and capital gains from investments, ITR 2, and when there is professional income or business income, then ITR 4. So the format of the forms, or maybe a little bit of complexity of the forms, may change. Choose the right form. If you have business income and if you pick up ITR 1, your return may not get filed. Then go to the income tax website. If there is any tax that is pending, that's to be paid, but because one has not paid advance tax, then this has to be paid with penalty. Now, what is advance tax? Every quarter one is required to pay tax. So when do you pay these taxes? Advance tax dates are 15th September, 15th December and 15th March every year. which essentially means while the year is going to end on 31st of the March, you would have made at least 3 advance tax payments based on your self-assessment. And this would be in September, December and March. And in March even further, there are 15 days left. How much advance tax do you pay? Before 15th March, 35%, additional 30% before 15th December, and the entire tax based on one's own assessment by 15th of March. Now see, this is where if you not paid these taxes, then when you prepare your return in June, July, 31st July being the date of filing the return, you would have to pay this tax with penalty. However, if you paid more tax, then you are likely to receive refund. In order to make the process little smooth and seamless, these mechanisms have been worked out. The last point becomes very important here. And this is true especially in cases where people are into uncertain income, which could be business income or professional income. If there is a large receipt or large income after 15th of March, then on that income whatever tax is due, if that income is unexpected and not provided for while paying the advance tax in March, that would attract penalty. But you use this Excel facility and prepare the tax return, and then the format that is required to be uploaded is called the XML file. Again, there is utility available on the IT website. So you convert the Excel file in which the return is prepared into XML, and this XML has to be uploaded. You would immediately get an acknowledgement that this XML is uploaded. At step number 4, ITR, it belongs to this particular PAN, etc., and PAN and Aadhaar are linked anyway, you know that. So the verification must be done through receiving an OTP. It could be either linked to Aadhaar card or bank account, etc., or one can go to and submit the form physically in the central processing unit. Within 120 days, this e-verification must be done. 120 days of filing the return. And from that point, the income tax department gets into action. If there is any discrepancy, they would send their own tax calculation and they'll demand additional tax. Otherwise, they'll process the refund. However, if the tax demanded is wrong according to you, one can respond electronically. That's through the facility available online, and get the errors corrected or rectified. Finally, after this whole process is complete, in 6th step, the taxpayer would receive tax refund if excess tax is paid. So in a nutshell, the whole chapter was about various financial products. We also talked about the tax applicable on the income receivable, if there are any tax exemptions associated with that. We also looked at the interest payable on loans, and is there any tax benefit available on those interest paid. Why do we pay tax? And for that purpose, we also took a quick look at the finances of Government of India, the inflows and outflows. And because we talked about income tax, we had a reasonably detailed look at the process of filing income tax return.